Your next reading is monetary and fiscal policy. This is your first learning outcome statement. Compare monetary and fiscal policy. Well, monetary policy involves central bank actions. In fact, central bank actions impact availability and price of money and credit. So, setting up interest rates, open market operations, we'll discuss in subsequent slides, bank reserve ratio requirements. So all these are covered within the monetary policy. When you say fiscal policy are actions by governments. It involves government spending. It involves taxation. These both monetary and fiscal policies are macro tools that are geared towards economic stability and growth. And of course, they are both government policies. Monetary policies are implemented by central bank, while the fiscal policy is implemented through laws. So here is a brief comparison between these two. Fiscal policy is the change in government spending and tax rates, whereas monetary policy is change in interest rates and money supply. Fiscal policy set by the government, monetary policy set by the central bank. Fiscal policy doesn't have any specific target. There we have a specific targeted inflation. Side effects on government budget and borrowing, side effects on exchange rate and housing markets, and finally, fiscal policy involves strong political dimensions to changing tax rates, whereas monetary policy is mostly independent from political process. Your next LOS is describe the functions and definitions of money. Okay, so how do we define money? Money basically is an economic unit that functions as a generally recognized medium of exchange. That is generally acceptable medium of exchange for transactional purposes in a particular economy. So that's how you define money. Then what are the functions of money? First, money is store of value. What does it mean? Store of value means that you can save money now, you can set it aside, you can save it now so as to spend this in the future. Because money is not perishable. About thousands of years ago, when there was no money, so people used to save in commodities, and of course commodities have a particular shelf life, so they can't be stored forever. So money is non-perishable, it can be stored as long as you want. Next is the unit of account. Unit of account means that money is used for pricing purpose. Like if I want to purchase an iPhone mobile, it will cost me $1,200, let's say. So this $1,200 number, this is how I have expressed the price of iPhone mobile. So it is used for price quotation, right? It's basically, it's a yardstick by which we measure economic transactions. Like if I want to purchase a Chinese mobile, it will cost me just $300. So $1,200 for an American iPhone mobile versus $300 versus Chinese mobile. Then that tells me which of these is more valuable. Then next is the medium of exchange. That means money is used to buy goods and services. I buy goods and I pay money. Someone buys my services like the CFA training, they pay me money. So money is used as a medium of exchange. It is used to buy goods and services. So effectively, money represents liquid assets for making purchases or settling debts. Then money as a means of deferred payment. What does it mean? It means that I can consume some goods or services on credit with the promise that I will pay for these goods and services in the future. So you can buy goods and services and the payment for it can be made in the future. So this is, the money is used as a means of deferred payment. Right, next is explain the money creation process. Money is created through lending. It is made possible because of fractional reserve lending. What is fractional reserve lending? Like in UK, for example, the fractional reserve requirement is 20%, which means if bank receives deposits of 50 euros, bank can keep a reserve of 20%, that is 10, and remaining 40 can be loaned out, right? Let's say a person takes loan and then deposited another bank B. Now for this bank B, this €40 represent deposit, and this bank B will keep a 20% reserve, 80%, 32 will be loaned out to another person, Y for example. Y take this money and deposits it in bank C. This deposit in bank C, 20% will be retained as reserve and 80% will be loaned out. So this is how reserve lending works. Banks are allowed to lend money more than they hold in reserve. Like 20% is held in reserve and remaining 80% has been lent. So if the reserve requirement is an example is 10%, so there will be more quantum of loans given out to the loan seeker. So bank can lend out 80% in this example. It could be 90% if the reserve requirement is 10%. So bank keep on lending out 80% of reserves they receive, which creates new money each time. So the total amount of money that can be created can be calculated using this arrangement: 1 upon a reserve requirement, that is 1 over, in our example, 20%, that means 5. So $1 deposit can generate money up to $5. €1, €5. Next, describe the theories of the demand for and supply of money. Quantity theory of money is the hypothesis that changes in prices correspond to changes in the money supply or monetary supply. The formula we use is M into V is equal to P into Y. Here M is the quantity of money, V is the velocity of money, the speed with which it changes hands, P is the price level in the economy, and Y is the real output. So as you can see, it's an equality. So if money supply increases, it would increase either price level or the real output of both, and vice versa. So they are linked this way. Any of the variables changes will affect the other variables. So there are 3 primary drivers of demand for money. Why we demand money, or why do we keep money? There are 3 reasons. The first reason we hold money, this idea was given by John Maynard Keynes, a famous British economist. He said that we keep money, the demand for money, is because of 3 motives. First is what he called as transaction motive. Transaction motive means we need money to make purchases, to do transaction. So this is the first motive, what you call the transaction motive. Second is the precautionary motive. Precautionary motive means I need money in case of emergencies. So having money, holding money to have in case of emergencies is what you call the precautionary motive. And the third one is interesting one. This is called the speculative motive. Speculative motive means you demand money for speculation in the future. For example, if I might get a future possibility of making sizable profits if I have cash. Like maybe my neighbor wants to sell his property at a throwaway price because he's going to relocate himself to the UAE market. So he's selling at a very low price. So if I have cash, I can use this cash to make money. I can take this money and make benefit for myself arising from some unexpected opportunity. All right. Next, these are the drivers of money which we have already discussed. These are the 3 drivers given by John Maynard Keynes. Transaction motive, precautionary motive, speculative motive, already discussed. Next, LOS. Describe the Fisher effect. Well, what is the Fisher effect? Fisher effect, it is named after Erwin Fisher. It states that the real interest rates are stable. So changes in the nominal rates, nominal interest rate, must be due to changes in expected inflation. So there is an equation that links this. So therefore, the sum of the required real rate of interest and the anticipated rate of inflation, real rate plus anticipated inflation, should be equal to nominal rate, apparently, right? But there is an appropriate equation for this. So therefore, the sum of required real rate of interest, and the anticipated inflation gives you the nominal interest rate, and the equation we use for this is 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. This is the equation that links your real rate and the inflation rate. So remember, investors can never be certain of the future values of economic variables such as the real growth and inflation. So basically, that's why this is compensated by the risk premium. Next verse is describe roles and objectives of the central bank. Well, when you say central bank, you are talking about Federal Reserve, you're talking about State Bank of Pakistan, you're talking about Reserve Bank of India. So central bank are the government's bank. What are their roles? First, currency regulations. Central banks have the sole authority to issue currency notes. So they are basically monopolies, issuer of currency notes in every country almost. Then control of commercial banks. Central banks are called banker of banks. So it regulates and oversees other banks in the economy. Then controller of credit. Well, that means the central bank use of monetary policy to manage credit availability. And remember, central bank is government's bank. It is the fiscal agent and at the same time advisor to the government. It receives deposits on behalf of the government and it makes payment on behalf of the government. And then custodian of cash reserves of commercial banks. Yes, as we discussed in the previous LOS, it holds reserves and transfers between banks as needed. And finally, the lender of last resort. What does it mean? If a bank is in trouble, central bank will provide necessary funding to such a troubled bank in the times of financial crisis. So overall, the primary objective of central bank is promoting financial stability. Your next LOS is contrast the cost of expected and unexpected inflation. Expected inflation. Well, inflation expectations are simply the rate at which people like you and me, consumer, businesses, investors. So expected inflation is the rate at which we expect prices to rise in the future. So keeping other things same, if inflation expectations rise by 1 percentage point, actual inflation will tend to rise by 1 percentage point as well. The next is unexpected inflation. Unexpected inflation is the inflation experience that is either above or below that which we expected. So basically, unexpected inflation affects the economic cycle. It leads to high risk premium and economic uncertainty. With higher uncertainty, lenders ask for a premium to compensate for the uncertainty. Your next LOS is describe tools used to implement monetary policy. The first tool is interest rate. The central bank influences the rates at which the banks lend money, and interest rates directly affect the variables of an economy. Open market operations that involve central bank buying and selling of securities to commercial bank that will change the money supply in the economy. Or in other words, these are the actions to add or remove money from the economy. And then finally, the reserve requirements discussed in the previous LOS. The changes in reserve requirement also can affect the monetary policy. So changes how much of banks' reserves they're able to lend. Like if it's 20%, means every bank, if it receives $100, it needs to keep $20 in reserve and $80 can be given out as loans. So these are the three primary tools used to implement monetary policy. Next LOS is describe the monetary transmission mechanism. Impact of monetary policy decisions on economic growth and asset prices. First, traditional interest rate channel. Well, if there is a decrease in interest rate, it will lead to more borrowing and hence more investment. So this would result in low weighted average cost of capital, and many firms will make investments in long-term projects. Balance sheet channel. Easing monetary policy, it would increase stock and asset prices. People will have money to buy assets and stocks, which leads to increased investment. And of course, this is the asset side of the balance sheet. That's why it's called balance sheet channel. Household liquidity effect. Increased wealth from rising asset prices leads to more consumption purchases. When your wealth increases, you tend to spend more. And then finally, the bank lending channel. When banks have more deposits resulting from loose monetary policy, it will lead to more lending activity. So bank will lend out more to the fund seekers. And then some other asset price effects on monetary policy. First is the wealth effect. Well, effects on stock prices caused by monetary policy consequently influence financial wealth and consumer spending on non-durable goods and services. And what are the effects on the exchange rates and net exports? When the real interest rates change, it will lead to changes in exchange rates, and that will eventually lead to changes in the net exports. Next LOS is describe qualities of effective central bank. The first quality is transparency. Central banks should publish or produce regular reports outlining economic conditions of different sectors. That's what happened in my country. Our central bank publishes regular reports regarding future economic outlook and the current state of affairs of different sectors of the economy. And most importantly, the decision-making process in the central bank should be well known and it should be consistent. Second point linked to this is that central bank must be free from political influence. They must be independent. Central bank must be willing to reduce money supply and slow growth when needed to control inflation, and vice versa. Mean they be willing to increase money supply when we need to spur the growth. And the last point here is credibility. The public must believe in the central bank's actions and reasons for acting. So these are the three qualities of effective central bank. Your next LOS is explain the relationship between monetary policy and economic growth, inflation, interest, and exchange rates. Okay, first, economic growth. Expansionary policy, it will stimulate economic growth by increasing money supply and lowering interest rates. Inflation. A contractionary policy, we discussed in the previous reading, it will slow inflation by contracting money supply. So central bank try to increase the money supply to increase the rate of inflation, or the central bank may decrease the money supply to decrease the rate of inflation. Then interest rates. The monetary policy influences interest rates for lending. The central bank has a policy rate at which it lends to commercial bank, and then that forms the rate at which certain addition is made as a spread, and then the money is lent out to the fund seekers. And finally, exchange rates. An expansionary policy increases countries' exchange rates relative to other countries, and at the same time, higher interest rates leads to higher exchange rates for the country currency. Now, why is it so? Let's say if interest rates in Pakistan is 12%, for example, so what we will see, lots of pounds, euros, dollars will come in Pakistan, be converted in PKR, so that this 12% interest can be earned. So this, in other words, means there will be more supply of pounds, euros, and dollars. So they will depreciate in value against Pakistani rupee. So higher interest rates lead to higher exchange rate for Pakistani rupees. So higher interest rate lead to higher exchange rates for the country's currency. Next we have the next LOS, determine whether a monetary policy is expansionary or contractionary. Okay, first, expansionary policy. Expansionary policy is intended to increase the supply of money and the lending activity. How it is done? When the government buys securities, when there is a reduction in discount rate, and when there is a decrease in the reserve requirement. So all these would result in expansion in the economy. So these are expansionary policy tools. Contrary to this, contractionary policy, it's intended to decrease the money supply by doing the reverse to what we have done earlier. So intended to decrease the money supply and the lending activity and to slow inflation. So here we bought securities, here we will sell securities, thereby the money supply would decrease. Increase discount rates, contraction. Increase reserve requirement, so they will be in the opposite direction. So increase in the reserve requirement, increase in discount rate, and sell securities in the open market. Okay, next. Describe the limitation of monetary policy. First, deflation. Well, central banks may keep on reducing rates 5%, 4, 3, 2, 0 even, without being able to reverse deflationary forces. So it can happen, even the rates are being lowered, but the reverse impact expected of deflationary forces is not witnessed. So that can happen. Severe decrease in lending activity. The central bank can influence lending, but it cannot force banks to increase lending activity. Liquidity trap. This is interesting. Short-term interest rates can be stuck at 0%. Trying to increase money supply only keeps interest rates low. So we are stuck in this liquidity trap. And then finally, an interesting concept, bond market vigilantes. A bond vigilante is basically a bond market investor who protests monetary or fiscal policy considered inflationary by just simply selling his bonds, thus increasing yields. So normally in the bond markets, prices move inversely to the yields. That's, I'm sure you know from your fixed income securities readings. When the investors perceive that inflation risk or credit risk is rising, they demand higher yields to compensate for the added risk. As a result, the bond prices fall and yields rise, which increases the net cost of borrowing. Thereby, it's one of the limitations of monetary policy. So next, LOS. Describe the roles and objectives of fiscal policy. Roles and objectives of fiscal policy. First, promote stable economic growth, manage inflation, encourage investment activity. This is supposed to be investment. There is no such word, intersegment. And then encourage consumption so that there is an increase in spending. And finally, ensure equal distribution of resources. So this is the role and objectives of fiscal policy. Next, describe tools of fiscal policy, including their advantages and disadvantages. First, fiscal policy is spending tool. It results in more expenditure. It could be the capital expenditure, long-term spending, building on roads, dams, bridges, and it could be the current expenditure or current spending. And then third could be the transfer payments. We discussed these earlier. Transfer payments. Social Security welfare system. So what they will do, they will increase the aggregate demand, reduce the unemployment, but there are certain limitations. Capital spending will take some time to implement. And then finally, too much recurrent spending, it will deplete government reserves. Then on the other side, we have revenue tools. Revenue tools that relates to taxation policies, direct taxes, and indirect tax. Direct taxes mean corporation income taxes. Indirect taxes are VATs and sales taxes. So Taxing certain behaviors discourages those activities like taxes on alcohol and cigarettes, also called the sin tax. So it will increase your tax revenue. Tax subsidies can encourage investments for various businesses. But taxes are unpopular and can be politically challenging to implement. Next, LOSs describe the argument about whether the size of a national debt relative to GDP matters. Well, if the debt is large, it can cause instability. Investor might lose confidence. The government must reduce spending to cover interest payments to the lenders, and increased currency printing may result and it can increase in inflation. Historically, these concerns do not usually cause significant problem. Situation becomes a problem when the debt is denominated in foreign currency, like our debt is denominated in US dollars. When economic growth is low for an extended period of time, debt will become a burden. And when government spending is in deficit during the period of growth. So these are the problems where debt will be a much heavier burden. These are the three areas that we have discussed. Next, we have explain the implementation of fiscal policy and difficulties of implementing them. First, fiscal policies are enacted through the passages of laws. What are the common difficulties? Common difficulties is the time lag. Time lag is that there is a delay between observed economic pattern and enacting of the policy changes. We want to bring some change, but it will take some time before the law is implemented and promulgated. So this is what you call the time lag. This is the difficulty. Second is inaccurate information. Policy changes based on predictions of the future may not play out. Recognition and impact lag. It takes time to recognize economic patterns. New policies enacted also take time before impact is felt. And finally, uncertainty in the economic future. Crowding out effect when the government borrows too much from the local banks and it leaves little for the private sector borrowing. This is called crowding out. And the public, of course, spending side effects. So these are the difficulties in enacted laws. Then we have the next LOS, and it says determine whether a fiscal policy is expansionary or contractionary. Fiscal policy. Previously it was monetary, expansionary and contractionary. So a fiscal policy is expansionary if it is intended to spur economic activity and growth through deficit spending, through tax cuts, or by providing subsidies. This is expansionary. To the contrary, contractionary fiscal policies intended to decrease the level of government debt and slow inflation growth. This would result in more revenues than spending. So effectively you will have a budget surplus and more taxes, less subsidies. This is contractionary fiscal policy. And then the last LOS, explain the interaction of monetary and fiscal policy. Both contractionary and expansionary. See, monetary and fiscal policy, they can either be expansionary and contractionary, fiscal policy and monetary policy. So sometimes when they are in conflict, they might cancel each other out. Like increase government spending, that's a fiscal measure, and increase money supply may cause excess growth and inflation. So they effectively cancel each other out. So they should ideally be coordinated to achieve the optimal economic outcome. Right? There must be coordination. So that completes your reading monetary and fiscal policy, CFA level 1.